Things are changing very quickly in the capital markets today, but investors looking to be a bit more defensive can shade their portfolios towards those REIT sectors that are less tied to overall economic growth and arguably more defensive than certain other property sectors.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest this week is Danny Ismail, Managing Director and Co-Head of Strategic Research at Green Street. Danny is here to share his thoughts on how real estate is positioned in the current highly volatile market environment created by last week's White House announcement on tariffs. Let me just note that we're recording this on the afternoon of Tuesday, April the 8th. Danny, thanks so much for joining the podcast this week.
Of course. Thank you for having me.
So, Danny, broadly speaking, can you put into historical context the extent of the current market losses and what the tariff announcements mean for macro fundamentals going forward?
Of course, I should preface this by saying that markets are incredibly volatile today. But at the moment, equity markets, as measured by the S&P 500, are down in the high single-digit to low double-digit range year to date. Credit spreads, so the difference between bonds with default risk and comparable U.S. government bonds, are wider as well, with investment-grade spreads about 50 bips higher and high-yield spreads over 150 bips higher. Equity REITs are down closer to 10%, depending on which index you use, anywhere from 7 to 10%. So clearly not a great start to the year. But if you compare the post-April 2nd market performance to the COVID drawdown or the GFC, it's not nearly been as severe as a reaction to the tariff announcements. Now, what that means for fundamentals, and I think why the market is reacting the way it is there's been a lot of ink spilled on what tariffs could do to various industries and sectors, but the end result is just an increase in recession odds. There's a good reason to fear a slowdown in economic growth resulting from an increase in tariffs, not just from an potentially higher import costs, but also a pullback in business investment as well as consumer spending. The saying, today is an increasingly uncertain time, is a bit cliche, but I think it applies very well to today's environment. And I don't think anyone knows with certainty how tariff negotiations will play out. And so it's difficult to say with any certainty how the overall economy will react, but we're in a period of higher than normal uncertainty. And that's made investors worry about future demands, which has led to valuations to come down across all risky asset classes.
And would you say that commercial real estate has been painted with the same brush as the rest of the market?
I think to a certain extent, real estate as measured by the reaction of public REITs has moved somewhat with the rest of the markets. We've also seen commercial real estate debt spreads widen as well. And it's not an unreasonable connection, as cash flow growth and the multiples applied to those cash flows should ebb and flow with the rest of the economy. However, it doesn't appear at the moment that real estate is expected to be hit as hard as other segments of the economy based on the initial post-tariff announcements. Obviously, things are very fluid, but it does appear that real estate is at the moment appearing to be a bit of a safer haven today.
And just looking a bit more specifically at REITs, how are they sitting ahead of last week's announcement?
Prior to the announcement, REITs were slightly outperforming the S&P 500 year to day. And I think what helps explain a lot of the post-tariff announcement performance is heading into the announcements, REIT valuations were, in our mind, attractive relative to the S&P 500. REITs had underperformed the S&P 500 by something like 30 to 40 percentage points cumulatively over the last 3 years. So a real significant amount of underperformance heading into the tariff announcements. And if you look at a comparison of REIT versus S&P 500 earning multiples versus history, as we do, it suggested that REITs were on the cheaper side heading into April 2nd's tariff announcements.
So post-tariff announcement, where would you say REITs are standing and why are they in that position?
So REITs have declined like any other risky asset class, but the decline has been less than that of other sectors in the economy. We'll see how the next few weeks shake out, but thus far, REITs and real estate appear to be a relative safe haven. And I think that's largely due to a few reasons, one of which I just mentioned, which was the starting valuation of REITs. REITs came into this environment on the cheaper side, while private real estate came in looking fairly valued as well. I don't think it's too much of an overstatement to mention that real estate came into this environment with a few body blows already, most recently because of the interest rate induced price declines over the last few years. So real estate has spent a few years lagging broader markets, and now hopefully that is reversing somewhat. There's a few reasons to be hopeful as well, particularly around the potential for lower supply growth given higher construction costs, which should be supportive of future rent and occupancy growth, all else equal. There's also a potential offset from a higher recession of lower interest rates, but that might be slightly offset by higher spreads. And lastly, there's the potential for a rotation of fund flows back into real estate. The last few years, fund flows across a variety of real estate verticals have been weaker than historical averages. And so a reversal of that would be a positive for the industry, including REITs.
Great. And are there certain REIT sectors that are potentially looking more attractive today, given all this turmoil?
So, not every sector reacted the same after the tariff announcements. We've looked at the economic sensitivity of REIT property sectors, and the post tariff performance generally lines up with that recent economic sensitivity. And so, generally, the best performing sectors have been those less tied to the broader economy. And so, that includes sectors like towers, manufactured homes, net lease, and gaming sectors, while the more economically sensitive sectors have underperformed, like retail and industrial. So things are changing very quickly in the capital markets today, but investors looking to be a bit more defensive can shade their portfolios towards those REIT sectors that are less tied to overall economic growth and arguably more defensive than certain other property sectors.
What do you see as some of the other factors potentially working in REIT's favor right now that investors should consider?
Aside from starting valuations, I do think that the structure of REITs is a real benefit today in the sense that public REITs are liquid and priced daily, which allows investors to see current market participants are thinking about the various property sectors today and to act opportunistically and reallocate portfolios as needed. Investors in less liquid structures have their hands tied effectively when volatility picks up, as it's harder to redeem or invest in certain other less liquid real estate vehicles. A second is balance sheets are generally not an issue for REITs today. REIT earnings have and are likely to be hit by higher interest rates as lower rate debt matures. But most REITs are not really facing balance sheet issues. So if we're heading towards a recession, who knows how protracted or when it'll come, but REITs are generally not facing balance sheet or leverage problems today in aggregates.
So, given that, would you expect REIT management teams to be making any particular changes to strategy right now? If they do, is there anything that you would like to see them be doing?
Yeah, I think the only material changes that we can see, at least in the near term, is that it's likely to see REITs pulling back a bit on external growth, particularly as interest rate volatility and uncertainty on private market pricing makes it difficult to get deals across the finish line. It's hard to assess where and by how much REITs have a cost of capital advantage today relative to the private markets, just given private market pricing is in flux. But we'll see what happens when the dust settles about how large that discrepancy between public and private market pricing might be. However, there were a few REIT property sectors heading into this downturn with a very large discrepancy between public and private market pricing. And in those situations, REIT management teams have the opportunity to sell assets in the private market for higher than their shares are trading in the public markets. And so that arbitrage opportunity, if it has widened and is actionable in the post-tariff environment, could be a real opportunity for REIT management teams over the next 3 to 6 months.
Before I let you go, any closing thoughts or words of reassurance for REIT investors right now?
Oh, words of reassurance. It's a bit tough in very volatile times. But I would say that I think there are reasons for optimism for real estate investors for the reasons I just mentioned. We are not heading into this potential downturn with what we're perceiving as very lofty valuations or relative valuation comparisons that are very far in other asset class favor. We are actually heading into this where real estate looks reasonably priced in the private markets, and in the public markets relative to the S&P 500, REITs looked relatively cheap. Lastly, I would say that the shelf life for these forecasts is significantly short. It is very difficult to have confidence in a forecast pre-April 2nd, and I think post-April 2nd, a lot of flexibility and an open mind is really needed to pivot when needed today. And so I think there's a lot we don't necessarily know, but as given all the information we have available to us today, it does appear that real estate and REITs are relatively better positions relative to other asset classes.
Danny, thanks so much for your time today.
Of course. Thank you so much.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.